Welcome back. Investors, of course, have focused lately most on the U.S.-China trade truce, the easing of tensions there. But our next guest says investors should also be watching other things like tax reform and deregulation in the U.S. Let's bring in Carol Schleif, Chief Market Strategist at BMO Private Wealth. Carol, thanks a lot for joining us. Let's talk first of all about this dialing down of tensions between the U.S. and China. Is the huge market rally we've seen on that news justified?
It definitely removes some of the potential tail risk, if you will, and it puts bounds around it. And I think the most important thing, the thing that markets are really rallying off of, is the fact that you've put the parties are at the table. They put a framework involved so that we don't escalate like this, because I think the U.S. authorities were surprised at China's hard pushback. But there's a lot of rationale and a lot of reason to stand on that they had grounds in terms of rebuilding their trade relationships over and markets, if you will, over the last 6 or 8 years. So China was in a firmer position, I think, to negotiate than many thought. But the fact that there's a framework there and that we've de-escalated and brought the parties to the table and is very positive news.
Meanwhile, we do see companies reporting negative effects from Chinese tariffs. Walmart is very much one of those today. What's your take on how the news thus far between the U.S. and China could affect companies and markets?
It's definitely important not to lose sight of the fact that even with this massive decompression, if you will, and bringing the rates back down, most companies in the U.S. are still dealing with tariff rates that are 4 or 5 times what they were at the start of the year. So those impacts aren't going away. You are seeing them in the numbers. You're seeing them in the guidance. And the weekly piece we write, this week's piece, we lay a lot of that out because of the fact that it's not like we're going back to pre-tariff days, and we won't ever get back there because President Trump has long believed in tariffs as a tool for a variety of things. And he's stated repeatedly that there will be some level of tariff in there. So at least, though, for companies, they have an ability to be able to put some framework around and hopefully do a little more accurate planning now than when it's a wide open field.
Okay, at what point do investors focus on things like deregulation, which was a big hope of investors when Donald Trump won the election back in November, and tax reform as well? We continue to get headlines out of the U.S. Congress on tax reform, not a whole lot of action, however.
Well, there's more action and more. They're bringing a lot more and more quickly than many had expected in terms of there are narrow margins in both the House and the Senate, but Mike Johnson in particular in the House is doing a good job at keeping the consensus together, if you will, so that tax write-up plans are progressing. His goal is to try to get it done by Memorial Day, which may be a little aggressive, but there are some really pro-business policies in there that both sides agree should be in there, which include immediate expensing of R&D and actually a first time ever sort of immediate expensing, if you will, of manufacturing capacity. And both of those provisions would be retroactive to the beginning of the year, which would hopefully, if those continue in the markup bill and continue making progress, those coupled with really leaning into the deregulatory process that the Trump administration is trying to push to. The narrative there is positive on both those for businesses, and it's some alleviation of the what remains as some of the unknowns with tariffs.
Do you like the U.S. financials, which really soared, if you recall, back in November when Trump won the election? It was on that deregulation theme, the idea that there would be more M&A, mergers and acquisitions in the U.S.
I think not only that, on the deregulation, you've also heard Treasury Secretary Bessent mention a couple of times that one of the first things they need from a deregulatory standpoint is to loosen the corset that's been put on the financial services. But you've also got the sheer volume that's trading. And so those shops that have big trading desks saw a lot of volume even when they reported first quarter. And that was before all of the volume that we've seen in April and into May. Plus, you've got a lot of the different shops that had staffed up, M&A and IPO folks that then have been put on the sidelines. And now you've seen some healthy IPOs and some occur this week and be unshelved and put back out there given how strong the markets have rebounded. So it should be good for financials overall.
Okay, what do you think of the consumer discretionary retailers? One story in the background there this morning is that there has been as expected, a substantial slowdown in retail spending in April versus March.
Yeah, it's a tough place to be. Hopefully they have a little more clarity, at least now, because a lot of them had been suspending shipments, bringing it in. And this is a critical season for those retailers getting ready for back to school and holiday. They have to be planning and shipping those goods now. So at least the 90-day reprieve allows them to set some framework around knowing what their costs will be to bring those goods. They can get them in. So hopefully we don't have the empty shelves. But yeah, some of it could be seasonal in terms of the weakness you saw today, but clearly there's a lot of consternation, if you will, especially early in April, as people were looking at 401k balances. There were some wealth effect overtones, if you will, to 401k balances, market returns, the headlines that were so continuously negative through most of that month. You've got an alleviation of some of that. So we'll see how the next couple of months come in, because the key factor for consumer spending is, are they employed? And that employment is likely to stay steady, especially if you need to staff ports and logistics and lots of stuff to get those goods in and on the shelf. It's likely to make sure, or to reinforce the stability in the employment market, which then should translate through to consumer spending.
Carol, thank you so much for joining us today. Carol Schleif is Chief Market Strategist at BMO Private Wealth.